Well, it's only been about 12 days so far this year, but it feels like a month or two. I have to say the markets have gotten off to a bit of an unsettled start. We remain, I think, constructive for the entire year, and that's based on the fact that the consumer is in generally a pretty healthy position right now. The manufacturing sector is doing well. New orders continue to rise. They're at a healthy level. And overall, we see about 8 to 10% earnings per share growth. And over longer time periods, stocks tend to follow the direction of corporate profits. So those are the positives. Over the short term, the markets are probably likely to remain unsettled. And there are really three reasons for that. And we've talked quite a bit about that. First is the Omicron virus. Second is the Fed. And third is inflation. And in terms of those three areas, the Fed is probably the biggest wild card. The Fed is moving from really ultra accommodative policy right now to accommodative policy. And at this point, four rate hikes are sort of penciled in by the markets for this year. So at some point, investors may sort of ease off the gas, and interest rates will probably stabilize because some of the pressure is already in the market already. In terms of the virus, the Omicron virus, clearly that's been a
well, Michael, let me cut in there, sure. Michael, let me cut in there and get back to rates, because we assume that a rate hike is going to be a quarter point. Bill Ackman and others have suggested maybe we need a half point, sort of a shock and awe type rate hike. I think there was somebody from JP Morgan's bond department yesterday that was calling for like 7 or 8 rate hikes this year. To you, how settled is the Fed? What do you think is going to happen?
Well, if you listen to the Powell Fed over the past couple of years, he does not like to surprise the market in a major way. So I think he's likely to take a prudent approach. They've sped up the number of rate hikes and the timing of that. And I think one of the issues also is that the market is dealing with rising rates at the same time that the Fed is now talking about allowing their balance sheet to roll off. So that quantitative tightening along with rate increases is really what's unsettled the market. It's that combination, I think. If you look back, unfortunately, to 2018, there was a period somewhat similar to this, and Powell sort of pivoted and took his foot off the brakes there. So I think the Fed is very unlikely to raise rates by 50 basis points unless inflation stays above this 6% level for a longer than expected period.
All right, so now let's go back to the other risks this year. You mentioned, obviously, Omicron. I published some stuff from the IHME. Hopefully this is winding down by March or April. Their estimates, not my opinion. What about the election? Let's move on. We forget that there's a massive midterm election coming up in November of this year. I know November seems like a long way away, Michael, but markets react before things actually occur. Do you think that could cause more volatility overall in stocks?
Well, I think at this point, the numbers indicate that, especially for a first-term president and also for a president whose approval rating is where Biden's is right now, it seems like the Republicans will be making serious gains in both the House and the Senate. So I think from the market's perspective, we've had a tremendous amount of stimulus, trillions of dollars over the past few years. And I think you could argue that's partly contributed to above average consumer spending and above average inflation that we're currently seeing. It's not the only reason we're seeing that high inflation. So to the extent that the Republicans come in and we see less in the way of fiscal spending, I think the markets may see that as a positive.